Welcome back to the channel. Today, we're diving deep into the latest inflation data from Germany and what it means for the country, the Eurozone, and global markets. With the latest figures coming in hotter than expected, the big question on everyone's mind is, what's next for the European Central Bank? Will they cut rates again, or is inflation sticking around longer than anticipated? According to provisional data from Germany's statistics agency, Destatis, the country's annual inflation rate for February remained at 2.8%. That's the same as January's figure, but slightly above the 2.7% forecast by economists surveyed by Reuters. Just a few months ago, inflation had dropped below the European Central Bank's 2% target in September 2024. But since then, it has been climbing again and has now stayed above that crucial mark for 5 consecutive months. So, what's driving this inflation, and what does it mean for you? Let's break it down. On a monthly basis, harmonized inflation in Germany rose by 0.6% in February. Core inflation, which excludes volatile food and energy prices, came in at 2.6%, slightly lower than January's 2.9%. That's a positive sign because core inflation gives us a clearer picture of underlying price pressures. According to Deutsche Bank research economist Sebastian Becker, the decline in core inflation is a good sign, and we should expect it to continue falling as wage growth slows and economic activity remains muted. One key area of concern is services inflation. While it did drop from 4% in January to 3.8% in February, the decline was smaller than expected. That's what Becker called a drop of bitterness in the data. This latest German inflation data is critical because it comes just days before the European Central Bank's next big decision on interest rates. The ECB has been on a rate-cutting path, reducing rates 5 times since last summer. Markets are now widely expecting another 25 basis point cut next week. But here's the big question. Will the ECB continue cutting rates, or will they take a more cautious approach? Some policymakers have already started pushing back against further rate cuts. The language used in the ECB's post-meeting statement will be key. Will they still describe monetary policy as restrictive, or will they signal a shift? Investors are watching this closely, as any signals from the ECB could impact bond markets, currency exchange rates, and stock prices across Europe. Beyond inflation, Germany's economy has been struggling. In the last quarter of 2024, GDP shrank by 0.2% after adjusting for inflation and seasonal factors. The country has been hovering around recession territory for a while now. Adding to the economic uncertainty is Germany's political landscape. Just last weekend, the conservative CDU-CSU alliance, led by Friedrich Merz, won the most votes in the German election. While Merz is in line to replace Olaf Scholz as chancellor, he will likely have to form a coalition with Scholz's Social Democratic Party. Merz has promised to revive Germany's economy through tax cuts, deregulation, and changes to social benefits. But how will these policies interact with the ECB's approach to inflation and interest rates? There are a lot of moving pieces here: rising inflation, ECB rate decisions, and political shifts in Germany. What should we expect next? If inflation stays stubbornly high, the ECB might have to slow down its rate cuts. On the other hand, if core inflation continues falling and the broader economy weakens, the central bank could be forced to act more aggressively to support growth. So what does this mean for you? If you're in Germany or anywhere in the Eurozone, pay close attention to the ECB's next decision. Interest rate cuts could make borrowing cheaper, but they could also lead to higher inflation if done too quickly. That's it for today's deep dive. What do you think? Will the ECB cut rates next week, or will inflation force them to wait? Drop your thoughts in the comments below. Don't forget to like, subscribe, and hit the notification bell so you don't miss our next update. See you next time.